ICOs have exploded cryptocurrency market growth, and in this chapter you will learn how to take full advantage of these opportunities. Chapter 6 introduces you to ICOs, their history and how they differ from other funding methods. We cover the ever-changing laws and regulations specific to ICOs, as well as different types to look out for. We simplify the process of selecting the best ICOs and then break down what you need to know to participate in an ICO. An initial coin offering, or ICO, is a type of crowdfunding or crowd investing tool using cryptocurrency. Most are done completely on top of the Ethereum blockchain. By using a smart contract, Ether or Bitcoin is collected and is exchanged for the new type of token. This process takes place entirely peer-to-peer without any exchanges or brokers. It is commonly used as a source of capital for startup companies and to fund the development of new cryptocurrencies. Companies can pre-sell units of their new cryptocurrency or tokens in exchange for already established cryptocurrencies like Bitcoin or Ether. The campaign process usually starts off with the presentation of a white paper. This white paper provides all the key information like business model details, the technical specifications of the project timeline, the target budget, where they detail how the future funds will be used, and finally distribution. And distribution is a key area to look at in your research because this tells you about the available token supply and how many coins the team intends to keep for themselves. Initial coin offerings are still a new concept. However, on August the 7th, 2017, CNBC reported that initial coin offerings had raised $1.2 billion and now surpass early-stage venture capital funding for internet companies. This is an impressive achievement, considering the first ICO was for Ripple in early 2013. And in late 2013, Mastercoin ran their own ICO campaign. The Ethereum project broke all crowdfunding records in 2014 within 4 weeks. The Ethereum blockchain has come to play a very important role in the increasing popularity of ICOs, as its platform has simplified the process of issuing tokens. This technology can be directly related to the record-breaking ICOs that have occurred in 2016 and 2017. The most notable was a project called the DAO, which was able to raise $150 million. ICOs share common traits with both crowdfunding and IPOs, to which they are often compared. But to some extent, they are more of a hybrid of the two. ICOs and IPOs, or initial public offerings, both offer their investors potential future profit, but also potential risk and failure. An IPO will sell a stake in the company so that investors have a portion of ownership. Most ICOs to date haven't sold tokens that act as a stake in their platforms. The only exception to this was in 2016, when the DAO campaign offered tokens that were attached to voting rights. Also, an ICO is supported by people who want to invest early in a product or service that hasn't been launched yet. This makes them different from IPOs and more like crowdfunding campaigns. Then again, crowdfunding is usually based on donations, while investors in an ICO hope to gain a return on their investment. Therefore, ICOs are really a mix between donation and investment. ICOs are still largely unregulated, and this is a dangerous situation for investors who lack knowledge and experience. Circumstances are changing rapidly because of the extreme success of ICOs like the DAO, bringing ICOs and the cryptocurrency market in general to people's attention. There are some geographic areas where they are regulated in a similar way to share and securities sales, although enforcement is still a challenge. Standards, regulations and laws should help to protect both investors and entrepreneurs. However, there is likely to be a downside to this. For example, the cost and effort required to meet compliance could reduce the advantages an ICO has over regular funding options.